What if I told you that you could boost your credit score by 100 points in just 30 days without handing over a single dollar to a credit repair company? That's not a gimmick, it's a proven strategy that works for thousands of people who have taken control of their credit and turned it into a real financial advantage. I'm not talking about chasing credit score hacks that disappear as quickly as they appear. I'm talking about the fundamentals that actually move the needle, the ones the credit bureaus themselves built their models on. In the next 10 to 15 minutes, we're going to unpack those fundamentals, walk through every lever you can pull, and I'll give you a realistic timeline for seeing real, measurable improvement. Ready? Let's dive in. First, let's talk about the 5 core factors that make up your FICO score, because everything else you hear about credit is just noise around these 5 pillars. Think of your score as a house built on 5 sturdy columns: payment history, amounts owed, length of credit history, new credit, and credit mix. If you understand how each column is weighted and what levers you can adjust, you'll know exactly where to focus your energy. Payment history is the biggest piece of the puzzle, accounting for roughly 35% of your score. It's simply whether you've paid your bills on time, and it's the single most powerful predictor of future behavior in the eyes of lenders. Miss a payment, even a single one, can knock a solid 750 score down into the high 600s, and the damage can linger for up to 7 years. Conversely, a flawless payment record is the fastest way to climb, because each on-time payment adds a small but cumulative boost. The trick here is consistency. You don't need to pay off a massive balance overnight, you just need to keep every single account current month after month. Set up autopay for at least the minimum due, and if you ever anticipate a cash crunch, reach out to the creditor before the due date and ask for a payment deferral or a hardship program. Most lenders are willing to work with you if you're proactive, and that proactive approach preserves your perfect payment history. Next up is amounts owed, which makes up about 30% of your score. This factor is all about how much debt you're carrying compared to your available credit limits, and it's measured by something called credit utilization. If you're using more than 30% of your total credit limit across all cards, you'll start to see a dip in your score, and if you're above 50%, the impact is even sharper. The sweet spot is under 10%, and that's where you'll see the biggest score jumps without having to pay down a mountain of debt. Here's a practical example. Imagine you have a $5,000 limit on a card and a $2,500 balance. That's 50% utilization, which is a red flag. Pay that balance down to $500 and you're now at just 10% utilization, instantly making your score look healthier. But there's a twist many people miss: you don't have to actually carry a zero balance. Some experts recommend keeping a small balance, say $20 to $30, on a card and paying it off in full each month. Why? Because lenders report your balance to the bureaus on the statement date, and if you pay it off before that date, you can lower the reported balance dramatically without changing your spending habits. It's a subtle timing hack that can shave a few points off your utilization instantly. Now, let's talk about length of credit history, which accounts for roughly 15% of your score. This factor looks at how long your accounts have been open and the age of your oldest account. The longer your oldest account, the more favorable it is for your score, because it signals experience with credit. That's why closing an old account can be a costly mistake. You're essentially erasing years of positive history and potentially lowering your average age of accounts. If you have an old card that you don't use often, the smart move is to keep it open, make a tiny purchase every few months, and pay it off right away. That way you preserve the age factor while still avoiding inactivity fees or potential closure. New credit contributes about 10% to your score, and it tracks recent applications and opened accounts. Every time you submit a hard inquiry, it can shave a few points off your score, and the effect can linger for up to 12 months. That's why you should space out loan or credit card applications by several months, and only apply when you truly need new credit. However, there's a silver lining. FICO treats multiple inquiries for the same type of loan, like shopping for a mortgage or auto loan, as a single inquiry if they occur within a short window, usually 45 days. So if you're comparing rates, do it quickly and you won't be penalized for shopping around. Finally, credit mix is the least heavily weighted factor at about 10%, but it still matters. It reflects the variety of credit accounts you have: credit cards, mortgages, auto loans, student loans, and so on. A healthy mix shows lenders you can manage different types of debt responsibly. If you only have credit cards, you might consider adding a small installment loan like a personal loan or a secured loan backed by a savings account to diversify your mix. Just don't take out a loan solely for the sake of mix. The costs and interest can outweigh the modest score bump you might get. Now that we've unpacked the 5 pillars, let's get into the tactics that actually move the needle fast. One of the most talked about shortcuts is the authorized user hack, and it's exactly what it sounds like. You become an authorized user on someone else's credit card, and their positive payment history gets added to your credit file. If the primary cardholder has a long, low utilization, on-time payment record, adding yourself as an authorized user can give your score a quick lift, especially if you have a thin credit file or a recent credit history. The key is choosing the right primary. They need to have a stellar payment history, low balances relative to limits, and a high credit limit to keep utilization low. And crucially, the card issuer must actually report authorized user activity to the credit bureaus. Some don't, so you have to verify that before you get added. Once you're on, you'll see the boost within a month or two, and it can be enough to push you over the threshold for better loan terms or lower interest rates. Just remember that if the primary's account ever goes delinquent, that negative information can also land on your report, so choose wisely and monitor the account regularly. Another powerful lever is strategic credit card churning, which isn't about opening endless new cards for the sake of points. It's about optimizing utilization and maximizing the age factor. The idea is to keep older cards open, even if you're not using them, to preserve the length of credit history, while opening a new card with a high limit to lower overall utilization. For example, if you have a $2,000 limit on a card you've had for 10 years, you might open a new card with a $10,000 limit, transfer a portion of your balances onto it, and keep the old card open with a tiny balance. The new high limit drops your overall utilization dramatically, and the old card continues to age, protecting your length factor. Just be mindful of annual fees and the impact of new hard inquiries. If a card has a high fee that outweighs the benefits, it may not be worth it. Now, let's talk about disputes, because sometimes the information on your report is simply wrong, and fixing it can produce an instant score jump. The Fair Credit Reporting Act gives you the right to dispute any inaccurate, incomplete, or unverifiable item on your credit report. The process starts with pulling your free annual credit reports from annualcreditreport.com, reviewing each line, and flagging anything that looks off, maybe a payment that was recorded as late when you paid on time, or a balance that doesn't match what you know you owed. Once you've identified an error, you file a dispute with the bureau, providing supporting documentation like bank statements or payment receipts. The bureau has 30 days to investigate and respond. If they can't verify the item, they must remove it. In practice, many consumers see a 10 to 30 point boost after a successful dispute, especially if the removed item was a recent late payment or a collection that was incorrectly reported. The secret to speeding up the process is to be thorough and to follow up if the bureau doesn't respond within the mandated window. Speaking of collections, there's a common myth that paying a collection will instantly improve your score. The reality is more nuanced. Modern scoring models treat paid collections differently, but older models still weigh them heavily. If you have an old collection, negotiating a pay-for-delete agreement or you pay the debt in exchange for the collector removing it from your report can be a game changer. While not all collectors will agree, some will, especially if you offer a lump sum settlement. Even if they refuse a full delete, paying the collection can stop further damage and may improve your score over time as newer, more recent activity outweighs the older negative mark. Now, let's put all these strategies together into a realistic timeline. If you start today with a score in the low 600s and you're diligent about the tactics we've discussed, here's what you can expect. In the first week, you can set up autopay to guarantee on-time payments, and you can begin monitoring your utilization by paying down balances before the statement date. By the end of the first month, you should see a modest 10 to 20 point increase if you keep utilization under 10% and have no new hard inquiries. If you add an authorized user account with a strong primary, you might see an additional 15 to 30 point jump within 45 to 60 days, provided the issuer reports authorized user activity. In the second month, start the dispute process for any errors you uncover. Many disputes are resolved within 30 days, delivering another 10 to 20 point bump. By the third month, if you've kept old accounts open, maintained low utilization, and perhaps added a small installment loan or secured credit card to diversify your mix, you could be hovering around the 700 plus range, assuming you started at 620. That's a 80 point gain in roughly 3 months without any expensive credit repair service. It's important to manage expectations, though. Credit scores don't magically jump overnight, they're a reflection of cumulative behavior. A single missed payment can undo weeks of progress, and hard inquiries can set you back a few points if you overapply. That's why the contrarian insight here is that sometimes carrying a small balance, just enough to show usage, can actually be beneficial, because it keeps the account active and prevents the issuer from closing it due to inactivity. Inactivity can lead to a lower credit limit or closure, which would spike your utilization and hurt your score. So a tiny, regularly paid balance is a strategic move, not a mistake. Another surprising fact is that closing a credit card can hurt your score more than you think, even if you've paid it off. The closure reduces your total available credit, instantly raising utilization, and it also shortens the average age of your accounts. I've seen people close a card after paying it off, only to watch their score dip by 20 points within a month. The smarter approach is to keep the card open, use it for a small recurring charge like a streaming service, and pay it off in full each month. That tiny usage keeps the account alive, preserves the limit, and protects both your utilization and your age factor. Now, let's talk about the role of timing with your statement dates. Most lenders report your balance to the credit bureaus on the last day of your billing cycle, which is often a few days before your due date. If you know that date, you can schedule a payment right after it to lower the reported balance. For instance, if your statement closes on the 15th and you normally pay on the 20th, consider making a payment on the 16th instead. That small shift can shave a few $100s off the balance that gets reported, and it can translate to a lower utilization percentage and a higher score. It's a subtle hack, but when you're chasing every point, those small adjustments add up. What about the impact of paying off a loan? Conventional wisdom says that paying off a loan will boost your score, but in reality, it can sometimes cause a slight dip. Why? Because the loan contributes to your credit mix and also to the age of your accounts. Once you pay it off, you lose that mix component, and the account may eventually be closed, shortening your credit history. If the loan was your only installment account, paying it off could reduce your credit mix score factor. So if you have a loan that's almost paid off and you're close to the finish line, it's often better to keep it open until you've maximized other score levers, then close it only when you're ready to move on to the next financial goal. Now, let's bring it all together in a practical action plan you can start today. First, pull your free credit reports and scan them for errors. Dispute any inaccurate items immediately. Second, identify the card with the highest limit and the lowest utilization and make a plan to keep that utilization under 10% by paying down balances before the statement date or by making a strategic payment right after the statement closes. Third, consider adding yourself as an authorized user on a family member's well-managed card, but only if they have a perfect payment history and the issuer reports authorized users. Fourth, keep all old accounts open, even if you don't use them frequently, and make a tiny purchase every few months to keep them active. Fifth, if you have a thin credit file, look into a small secured loan or a credit builder loan to add mix and length, but only if the interest and fees are reasonable. Finally, set up autopay for every account to protect your payment history, and monitor your score weekly using a free service like Credit Karma or your bank's credit monitoring tool to see real-time changes. One last thought before we wrap up: credit scores are not a static number, they're a living reflection of your financial habits. The moment you start treating them as a game you can win with shortcuts, you risk undermining the very foundation: consistent, on-time payments and responsible credit usage. But when you master those fundamentals and use the levers wisely, you can accelerate your score faster than most people think possible. In the next few weeks you'll likely notice your score climb, and those gains will open doors to better interest rates, higher credit limits, and new opportunities you may have thought were out of reach. If you found this video helpful, hit the like button, subscribe, and ring the notification bell so you never miss a deep dive into personal finance strategies that actually work. Drop a comment below with the credit challenge you're facing, whether it's a low score, a stubborn collection, or a confusing report, and I'll answer your questions in the next video. Remember, financial freedom starts with understanding the tools you have. Your credit score is one of the most powerful tools you can control. Thanks for watching, and let's get that score soaring.